Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name's Manpreet, and welcome to Through the Noise, which we're recording today on what has been a relatively eventful Valentine's Day. Now, is US equity market leadership being challenged? After what's been a period of significant outperformance, US equity markets continue to do well, but not quite as much as the European or Chinese peers in recent weeks. Now, this comes at a time when US President Trump's trade tariff policies continue to gather pace alongside. So, is this a temporary blip, or should we be watching out for the start of a longer term reversal? To discuss this question and more, today I'm joined by Audrey, who's head of Allocation at the CIO office. So, welcome, Audrey. Thanks for joining us today. Um, so, I suppose with all the rhetoric we're hearing in the US, of course, on tariffs, now the reciprocal tariffs, uh, do you see sort of the leadership in terms of returns of US equity markets being challenged, or is this sort of just a period of temporary outperformance?
Hi, Manpreet. So, if we look at both markets, they have underperformed the US equities quite significantly over the past 12 months. So, some reversal, is not entirely a surprise. And if you look at their performance, both European as well as Chinese equities have gained almost 10% this year and clearly outperforming the US. However, in order to see sustained outperformance in both Europe as well as China, we would also likely need to see a revival in their earnings estimates, as well as a weaker dollar, which, as many of us know, has been on quite a strengthening trend since the start of this year. So for the US dollar to weaken, Fed will have to continue to cut rates, and this week's hot inflation data is likely going to keep the Fed on hold for now. And if you look at both Europe as well as China, both authorities will also need to take decisive actions to stimulate domestic demand and certainly to negotiate trade deals with the US to ease concern over tariffs, which is a clear overhang on the equity markets. So, without these conditions being met, we remain of the view that US equities is still likely to continue to outperform. And having said that, we also continue to overweight with like gold as well. So even though in the very short term, gold looks a bit overbought, I think it is one asset class where we would be happy to buy on dips, given broadening demand, particularly from a structural basis coming from central banks.
All right. Let's just continue maybe the conversation on the Chinese equity part because we do have Chinese internet companies reporting earning next week. What's your outlook, particularly on that sector?
So it will be quite an important earnings season to be watching out for, and investors will likely be looking out for any improvements in consumer sentiment. Clearly, US tariffs remains a risk, but a stimulus policy action by the authorities could potentially help to mitigate that. And so, what is more important for the China equities market near term is really companies' guidance on the impact of AI and AI applications on their business and profitability. So in recent weeks, we've also seen the emergence of DeepSeek in terms of the prospects of developing low-cost AI applications. And that has excited the market recently because it basically demonstrated the ability of China companies to be at the forefront of AI development, even without access to the most advanced semiconductors chips out there. So the prospects of affordable AI adoption with the subsequent uplift to growth as well as productivity is clearly prompting a reassessment by investors with regards to China equities and China equity valuations. So if you look at our in-house technical models, it has recently turned positive on China equity as well, which suggests further upside from here in the short term. However, if you look at it from a fundamental perspective, consensus earnings growth, whether it's in 2025 and 2026, they have yet to show any material uplift for now. So the likelihood of further short-term upside in Chinese equities notwithstanding, our preference over a 6 months horizon is to continue maintaining a barbell approach via Hang Seng Technology Index, which has done really well since the beginning of this year, pairing them together with high dividend, non-financials, state-owned equities.
All right. I want to move on to another topic, which is gold. Obviously, an asset class that has done very well recently. What's your view on the outlook from here? I mean, we've just hit fresh record highs. So, can this continue, or are we due a pullback?
Yeah, so gold is also one asset class that we have been overweight on since our annual outlook. And if you look at gold prices, it is poised to post its seventh consecutive weeks of gains, which is its longest winning streak since 2020. And clearly, that has been in fact impacted or influenced by fears of potential US tariffs, which may include precious metal. Basically leading traders to rush physical gold to New York, thereby tightening supply and creating market distortion. We've also seen some of the distortion, including a sharp rise in gold lease rate, for example, which is the returns that bullion holders earn from loaning out their gold, and also an opening up an arbitrage opportunity between the COMEX as well as international benchmark prices. So our in-house model on gold basically illustrates that it's been significantly influenced by trade uncertainty, which has outweighed movements in real yield and US dollar, which were traditional drivers of gold prices. And this suggests to us that gold prices are likely to remain well supported, given that there could be further US tariff announcements coming through over the next weeks and months. From a technical perspective, investors' position in gold is clearly pretty elevated, but the uptrend also remains quite strong. So if you look at months to date, the volume have been above average, indicating sustained buying interest. So we wouldn't be surprised to see any, brief correction to $2,700, which will align well with previous highs. But we will also view such a pullback as a buying opportunity, given ongoing structural demand coming from central bank as well as emerging markets.
Okay, I guess that begs a related question on the Aussie dollar. I mean, that's often a currency that's driven by gold prices as well, but we do have an RBA rate decision next week as well. So, what are your thoughts there?
So Aussie dollar remains supported by resilient, if not outright strong gold prices, but there could be downside risk. Given coming from weaker fundamentals near terms, so if you look at the Australian Q4 CPI, that came in below expectations, down to 2.4% from 2.8%. And then PPI, which is the producer price index, and the retail sales growth were also quite lackluster, basically signaling underlying, some economic weakness there. So markets now expect the RBA to cut rates by 25 basis point next week, and totaling, about 75 basis point for the whole of 2025. So a dovish shift in terms of monetary policy could well weigh on the Aussie dollar, especially against a backdrop of a stronger US dollar. So from our point of view, we expect Aussie dollar to stabilize around its 50-day moving average of around 0.6260, with a key technical support at 0.6130 and clearly upside resistance at around 0.6470. And the recent soft China inflation data that we saw recently also added to hopes for greater fiscal stimulus following the upcoming March MPC meeting in China, which can present upside risk to our view on the Aussie dollars.
All right, and finally, we've spoken about obviously strong performing equity markets, gold markets, but what about on the bond side, the rally in developed market high yield bonds? Do you expect that can continue as well?
Yeah, so developed market high yield bonds have returned 1.6% year to date, are pretty robust and outperforming their investment grade peers. Their yield premium over risk free rate, which is what we also commonly call as credit spread, is now at a post 2008 low, despite pretty strong supply of new issuance in recent weeks. And we attribute this to resilience in terms of US payroll data, very solid Q4 earnings, both of which basically supported investors' confidence in this asset class, as we've also seen surging fund inflows into DM high yield space in over the past few weeks as well. So we continue to overweight DM high yield bonds, and we do expect this asset class to outperform other bond asset classes, given the backdrop of still resilient US economic growth and also increased deal regulatory stance or measures under the Trump administration. So fundamentals is likely to be quite well supported. And looking forward as well, if the Fed continues to cut rates further this year, this would mean that refinancing conditions for some of the high yield companies will also improve, which would then allow default rates to stay close to pretty much historical low levels as it is today. While clearly trade tariffs represent a risk, If you look at the composition of developed market high yield bonds, they are largely comprised of the consumer discretionary sector, followed by financials and communications, most of which are quite domestically focused. So it does offer a certain degree of defensiveness as well against rising uncertainty with regards to global trade policies.
All right. Some interesting comments there, but that does bring us to the end of time. So we'll end the conversation on that note. Thanks very much, Audrey, for that detailed conversation and wide-ranging conversation today. My top takeaways, if I talk about the top three, number one, really still focused on US equities. Unless we see more of a significant change on fundamentals, we expect that relative outperformance to return. Second, of course, gold perhaps rallied a little bit too far in the short term, but we'd be quite happy to buy on dips. And finally, of course, we do believe it's attractive to stay the course when it comes to developed market high yield bonds. So thank you again for taking to join us on this podcast. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.